Okay, I think it's time. So hello everybody and welcome to this webinar on whether local flexibility markets can solve the future challenges in distribution grids organized within the FlexiGrid project. We have an agenda for you where we'll be starting off with an introductory phase. There will be an introduction to FlexiGrid, the project, to flexibility by Nima from Chalmers, who will present himself and flexibility later on, and also an introduction to market design principles from an economic theory point of view. Then we will have an introduction by Nima from Chalmers again to the FlexiGrid's peer-to-pool market design, followed by Thong from Emacs, who will present FlexiGrid's peer-to-peer market design. There will be time for questions after the peer-to-pool market design and after the peer-to-peer market design presentation. So if you have any questions prior to that, just please take a note and we'll let you in later on. Yeah, let's wait no longer and kick this off with an introduction to FlexiGrid, the project. So this is an innovation project that's funded by EU's Research and Innovation Program, Horizon 2020. The project will create an enabling architecture for small and medium DSOs, or distribution system operators, to unlock flexibility resources by providing them with a variety of tools to help them meet the demands of the transition. So the project objectives are to develop an architecture for flexibility measures and electricity grid services provided by storage of electricity, vehicle charging, power to heat demand response, and variable regeneration to enable additional decarbonation, to define, test, deploy, and demonstrate markets and market mechanisms that incentivize flexibility in order to mitigate short-term and long-term congestions and also other problems in the distribution network, such as voltage issues, etc. To drive cooperation between distribution system operators, DSOs, consumers, and generators by defining market interactions, facilitating the integration of wholesale and retail markets and cross-sector interactions. To deploy smart grid technologies, to enable the architecture and markets, bringing actors together to participate as distributed energy sources, driving increased resilience of the electricity grid, increased system security, greater observability, higher automation, and improved control of the grid. And to enable future technical and commercial innovation, for example, by identifying barriers to innovation, developing pathways to regulatory and policy reform, developing business models, and enabling strategic collaboration between different parties. So the FlexiGrid demo areas are located in 4 different countries, being Sweden, Switzerland, Bulgaria, and Turkey. Each have different focuses, such as grid monitoring, local markets, blockchain solutions, and electric vehicles. In Sweden and Switzerland, one of the focuses is grid monitoring, control, and flexibility intervention. This means creating new solutions for monitoring the electricity grid in order to see and predict the supply and demand for electricity. Using an IoT platform together with other solutions, it's possible to see when the network is being overused and predict potential opportunity arising from this. In Sweden, we also focus on demo area 2, that is the local energy market and the exchange of energy and/or grid services. And you will hear more about this later on, but in short, the demo will test a local centralized market approach facilitating both energy and grid services trade with support from an IoT platform. Demo area 3 is investigated in the demos in Bulgaria, Turkey, and Switzerland. And here we test a blockchain-based trading system with the purpose to enable smart procurement of energy and for electricity network owners. And lastly, we have in Turkey and Switzerland a demo area number 4, which is about vehicle to grid, working with gas storages and other types of storage solutions. So the consortia that we have, it consists of 16 different partners popping up on the screen as we speak. We are all led by IMCG, but we also have and we're all from 7 different countries, and we also have a collaboration with Canada. And FlexiGrid was kicked off in the end of 2019, and it will run for a total of 3.5 years. And if you have any questions regarding the project, just take a look at the website. It's flexigrid.org, or feel free to reach out to either any one of us presenting in this webinar, or find contact details on LinkedIn or the website. Good. And with that, it's time for the second part of this introduction, where we will sort of take a step back and look at what is flexibility. So I'm handing over to Nima Chalmers.
Thank you, Sophia. I'll just share my screen. Here we go. All right. My name is Nima. I'm doing my PhD at Chalmers University, and my research is mainly focused on flexibility at the distribution grids. At the moment, I'm working mostly with local flexibility markets that we will hear more today about. Before we go into the details of the flexibility markets, we thought we take a step back and give an introduction to flexibility, make sure we are all on the same page, have the same definitions. So I thought to explain it in 3 different steps, like why do we need flexibility, then what is flexibility and how to obtain it, what are the different ways that we can activate flexibility in the grid. So this question of why do we need flexibility, you might have heard a lot about it, so I would try to go fast through it. So we have a few trends. Trends are in this row, and then these trends have some consequences, and these consequences will cause some technical challenges for us to operate the grid. So we see, for example, this trend of moving from centralized big power plants to distributed renewable sources. They are harder to predict, they are harder to manage because they are distributed. We might face also some reverse power flows in the system. Electrification of different sectors, like transportation or heating, will cause new loads and new peaks in the system, which can cause some challenges. We see also this trend, or anticipate this, seeing this trend of consumers becoming more active and responsive, becoming more smart, responding to the, for example, the spot prices. What can that do is that we might see some concurrency of behavior if everyone responds to the same price at the same time, which can cause high peaks and deep valleys. It can be a challenge, but it is an opportunity as well, because the end users are responsive. So if we give the right signal, we might be able to use this opportunity. Imbalance between demand and supply will cause frequency issues. This is one of the challenges in the future. Congestions we might face, especially at the regional and local distribution levels. Protection challenges regarding the reverse power flows, and also voltage limit violations if we cannot keep the voltage within the accepted range. What is flexibility? Very simple explanation that I could thought of is to be flexible, and being flexible in generating electricity and or consuming electricity. It can be also energy, like if we have another energy carrier than electricity, but eventually being flexible in generating or consuming. To open up further the question of what is flexibility, I found this figure very useful. It's from a report by Energiforsk. They have mapped the electricity system's different needs and challenges in the energy transition. So here you can see we have the system level, like the TSO level, regional DSO and local DSO. Here is the time scale from years to milliseconds. So here, for example, we can see that we need to make the long-term energy balance, like by making connection capacities to other countries, make available seasonal storage somehow, geographical smoothing, these words that you might have heard. Frequency regulation, we need we need inertia in the system to also help the frequency. We need the grid capacity to be able to transfer the electricity, especially this can be a challenge that is discussed a lot for the DSOs. Voltage regulation, flickers, and some protection issues with short circuit or reverse power flows you might face. So having that in mind, my personal experience has been that I have been hearing word flexibility a lot in different forums. And it was a bit confusing sometimes. What do we mean by flexibility? So here, I want to try to put it into some context. What are the different types of or usage of flexibility in the context of different system needs? So here are the 4 of the needs that we can use flexibility for in the system. And I have found this figure also from Matthias Persson very useful. Defining flexibility. And so here you can see if you're talking about at the higher level at the system and over the terms of a few years up to 1 days or hours, we can call it flexibility for energy. Maybe it's all just definitions, but to make sure we have the same definitions. Flexibility for frequency regulation, we can call it flex for power. Using flexibility for capacity, can come here, and also using flexibility for voltage. I hope that makes sense. It helped me a bit understand better what do we mean by flexibility in different contexts. To take that further, maybe the next step is to, now that we know what is flexibility and why do we need it, then how can we activate flexibility? There are I have tried to list different methods here for activating flexibility. It might not be only limited to this, but yeah, these are the ones I could think of. So the first 4 ones in Nordics and in Sweden, these are the products on the balancing market in Nord Pool that you might have seen. I will not go into the details, but they are one way to achieve flexibility. Local flexibility markets are another solution, which is basically a new market for regional and local needs, which were the capacity and voltage needs. They have their own products, trading zones, and timelines. Power tariffs or innovative tariffs can be another way to impact the end user's behavior. So this can be another way to activate flexibility. Active grid management, I will call it, I have seen the word grid side flexibility. We can do network reconfiguration or other approaches to have this flexibility. Grid reinforcement is not really flexibility, but I have included here because it's the conventional way to address the regional and local needs. Local energy markets are also another way to approach this, but this is not flexibility either, but like indirectly solving the issues at the local levels. And in simple words, maybe it's just, for example, instead of having 4 trading zones in Sweden, think about having thousands of zones for trading. So local energy markets in every local area. So I have tried to put it now here, those ways to activate flexibility, obtain flexibility in this figure that we had. So here you can see, for example, the balancing products are coming for on this part of the figure. Then grid investments, local flexibility markets, active grid control, or power tariffs can come here, answer this part of the needs. And in this webinar, we are focusing on local flexibility markets mainly. Yeah, regarding the long-term energy balance, I have put it here because like some of you might have heard, we can hear about seasonal storage, like inter-country transmission lines, capacity markets. There are also methods to solve the issue, having the long-term energy balance. It's not necessarily flexibility all the time, but maybe it's good to have that in the perspective to understand the big picture. Yeah, bottom line here, Flexibility can have different usages or different types depending on the context, which meeting we are participating, which community, which forum we are participating. And also, I wanted to highlight that there are various ways to obtain flexibility, and local flexibility markets are one of them. So yeah, and today we will discuss more about that. So next part, I will hand over again to Sophia, talking about suitable market properties from economics theory. Yes.
Yes, let me share my screen. Okay. Yeah, so let's head into the last part of the introduction phase of this webinar, which is looking at market design principles. And this is from, well, it's based on economic theory, basically. So that's the standpoint that we have. And we will go through some background and talk about what is an efficient market from a theoretical standpoint. What are some of the potential issues that we can see with local flexibility markets in the real world? How can inefficiencies be mitigated? And and last, some things to have in mind when deciding on market design. So some background, well, some of the markets, or most markets that we have around us, has somehow appeared naturally from someone needing something that someone else has and making a deal based on that. So it's demand, supply, and probably some competition in the end. Electricity markets are a bit different because they are designed, and we also have quite a few complicating factors, such as the regulated electricity distribution run by natural monopolies and so on. And the local flexibility market will also not be appearing naturally. It will involve quite heavy regulation. It will also involve lonely actors, such as the opposite of a monopoly, which is the lonely buyer, is likely to occur in at least some of the market structures. And also completely new actors that has never been involved in this quite complicated industry. So this is quite challenging, and designing a local flexibility market will require a multidisciplinary approach. So, and also for the design to be successful, we believe that it will be very dependent on the context. It's also important to keep the objectives of the regulator in mind when thinking about these things. And in the short run, they want to make the best use of existing resources. And in the long run, they want to provide, or they want to ensure that the market efficiently provides incentives for the proper long run investments by the relevant actors. And let's look then at the economic theory and what it tells us that we need for a market to function efficiently. So first, we will need some standardized products. And this means that the products offered in the market are homogeneous in the sense that consumers will view them as interchangeable. And next, sellers should be price takers, which they are when each individual seller lacks market power, and therefore they must treat the market price as a given. So they will not be able to affect the price by, for example, increasing or decreasing the provided quantity, such as we can see, for example, on the market for oil. And sellers are much more likely to be price takers on a market where there are many sellers and therefore quite small individual market shares. But if entry and exit is working properly, they might also be price takers on a market with few sellers. And the reason for that is that smooth entry often puts a downward pressure on price. So if a seller on a market is making a profit, others will be likely to enter that market to get some of that profit and therefore increase competition and hence efficiency in the market. And last, we have perfect information, meaning that market participants will have perfect and equal knowledge of prices, costs, and their own utility, etc. And as you may imagine, all of these things are rarely, if ever, achieved. And for these markets that we're talking about, it's for example, quite unlikely that consumers are aware of how their energy use affect climate. We could infer a cost to them, or they might not even have any proper information about energy prices whatsoever. An example of a market that is sometimes referred to as at least it's close to perfect competition, but not quite, is the stock market. This market have many participants, it's close to perfect information, and there are few entry and exit barriers, but it's still not perfect because we do have institutional investors that are likely to be able to influence price, and they are therefore not price takers. So although perfect competition and a super efficient market is quite difficult to achieve, it should always, of course, be endeavored when thinking about market design. And now let's look at some issues that the local flexibility market may encounter related to this economic theory. So first, we had this thing with standardized products, and flexibility services from different actors may not be interchangeable. That is not standard. So for example, location is super important in the local flexibility market. Also, timing is very important. Second, there might be few actors, and in some cases only one buyer in the DSO. This might be a problem for market liquidity, and that means that when we don't have sufficient market liquidity, it can be difficult for a buyer to find a seller or a seller to find a buyer. Thirdly, there are upfront investment costs and some burdensome rules that you have to understand, which can create barriers to entry. And fourth, information and knowledge and also risk level is likely to differ quite a lot between different actors, also creating this skewed just the power is basically not really equal. So what are some things that we can have in mind when trying to mitigate inefficiencies? Well, first, it's market size. So the market size, it must be large enough to offset issues related to the availability of buyers, sellers, available flexibility, so the liquidity I just mentioned. But it should also be small enough because it has to be able to solve location-specific issues where they're needed. Second, the information asymmetry. The market design should cater for leveling the availability of information between market actors. So, for example, ensuring that well-informed aggregators can enter the market and act on behalf of small actors and households with less information. This could help mitigate issues related to the information asymmetry. We have market access. The market design should ensure that no one or no consumer is worse off after it being implemented, or at least it should be able to adjust any unfairness through some compensation of some sort. So for example, we have some price sensitive end consumers without the access to or the ability, financial or whatever, to get a PV or an EV, that's solar panels or electric vehicles. They should not face increasing prices or costs due to their inability to participate on the local market. Fourth, we have incentives. In some places, we have a relatively low cost of traded electricity and flexibility potential of individual actors. So gains may not be large enough for some for them to have an interest in participating. However, all incentives are not financial, but this is a discussion popping up once in a while, especially among economists, that the demand of electricity is quite inelastic, meaning that the interest in participating in this kind of trade is perhaps quite low. At least it has to be easy so that we don't increase the cost for participation. Yeah, and then of course we can also think about applying appropriate and enforceable rules when it comes to rules and regulations. Then we have some practical principles that we can keep in mind. Market platforms, whatever it is we're trading, it should be transparent and accessible. They should be operated by a neutral third party, and they should also be technology neutral. The design should focus on addressing local needs and pave the way for appropriate locational price signals. And by integrating with the existing short-term power market, we can avoid needs to redesign established markets. And there is a lot of unbundling in the energy sector, which must be considered so that we don't mess that up. We also need to make sure that system operators have the right incentives for cost-effective system management. So this is the financial side from the other from the DSO side. As it is now, the financial regulation is quite heavy focus on the CapEx side. If we had a more holistic approach, that could be a solution. So there aren't really any concrete answers from the economic theory, but we do have some principles that can be used as a guide, and it's important to keep track of context. That's like what we bring with us. And let's leave this part of the introduction with a few questions that we can have in the back of our head. So think about market structure. What is the context? What is most appropriate? I'll not dive more into this because we will hear from both Nima and Thong on this. Product design. So what will the traded product look like and how can it be made accessible to as many as possible? The clearing algorithm, can it be designed to be transparent and therefore induce truthful, efficient bidding? Settlement. How are cleared bids settled and what happens if someone is unable to deliver what they promised? What are the different roles and responsibilities and of who in this new setting? And also what, for your market, what is a proper trading horizon? So with that, I will hand back over to Nima and the next part of this presentation. And I just want to mention, you can go ahead and share your screen, but we there will be, as I mentioned in the chat, there will be a report published on the website where you sort of, this is sort of a nice introduction to that report, I would say, this whole webinar. So I urge you to go ahead and find that later on. But yeah, over to you, Nima.
Thank you. Right. Here we go. Yeah, so this section, I will try my best to explain a bit on the local peer-to-pool flexibility markets. But first, and I tried to formulate it in this order, like first discussing what do we mean with peer-to-pool, and then what are the common challenges in the design of these markets. Sophia mentioned some of them. I will dig a bit more into some of them, and then I will try to present the market design that we have addressing these challenges, and then some future work that we are planning to do. So yeah, peer-to-pool local flexibility markets. It's a centralized market compared to peer-to-peer that you have trading just peer-to-peer. This one is you will submit your bid into some kind of pool, and this pool is managed by a market operator. So the buyers, which are the system operators, will ask for some for the flexibility product, and the flexibility service providers will submit their bids. And then when we are designing the market, we have to, as Sophia mentioned briefly at the end, have to decide on the product design, on the market timeline, on the clearing algorithm. Clearing algorithm is basically whose bid is getting accepted or rejected and based on what criteria. And settlement, like how do we verify if the service is delivered or not, and also deciding on who will pay how much and who will get paid how much, and the penalties, etc. So some of the main challenges I have listed 4 here: low market liquidity, baseline issues you might have heard about, forecast errors at this level in the grid, measurement costs. It's not only limited to this, but these are among the ones that are mentioned a lot, and also these are the ones that we have tried to address in our work. So low market liquidity, what does first maybe liquidity means is, I think in simple words, it's try to, if a market is liquid enough, then you will be able to buy or sell easily and without impacting the price in the market. So for example, if we don't have enough buyers or sellers in the market, then it's hard to, the market is not liquid, because if I'm a buyer, then there might not be a seller that wants to sell it at that specific time, so it's not liquid enough, and the other way around. So why the market liquidity can be low in local flexibility markets? First is due to geographical limits. Like imagine in a neighborhood in like Gothenburg, how many flexible users or how many consumers are available downstream of a transformer. It might be very limited and by the geography of the area. And also availability of the flexible resources can be another reason, which is maybe the issue through the transition. Like, do we have enough flexible assets available or not? How can we increase that? Consequences of it can be like security of supply for flexibility. Let's say that a DSO have decided not to reinforce the grid, and now tomorrow we will have the forecast show that we will have a congestion in the grid, and a DSO wants to purchase that flexibility. You cannot reinforce the grid over the night. You cannot change a transformer over the night. So if you don't have this security of supply for flexibility, you might end up having problems supplying electricity. It's the same also for the demand for flexibility. Like, let's say I'm a flexibility service provider. I have invested in flexible assets, but I'm not sure if there will be a need for this flexibility that I can provide later. But then how can I be sure that my investments will be paid back? So that's another challenge if we don't have a liquid market. And also, again, Sophia mentioned this one also, that in local flexibility markets, if I have no number of participants due to these reasons, then there is low competition in the market, and low competition in the market can bring the potential of market manipulation. Like if the flexibility service providers, they know that the DSO is really in need of this flexibility service tomorrow and cannot do anything else, so they can just increase the price a lot, which is, can see it as market manipulation. The other challenge, baseline, this one you might have heard a lot, but what is baseline-based products? The literature I have seen, the flexibility products can be 2 main types: baseline-based and limit-based. Baseline-based, also called as schedule-based. What is baseline is, for example, it's like a forecast of anticipated loading in the coming time period that we have. And if it goes over, for example, the transformer rating, then we need to purchase the flexibility. And then the flexibility product or the service is defined with respect to this baseline. So the service that will be purchased is like a certain percentage or kilowatt deviation from this baseline. Or the other way around. Limit-based products, I will explain a bit later, so let's reserve that. But what are the challenges for baselines? It's hard to forecast them, especially at the low aggregation level. And also, if we start selling flexibility, then for the like past few days, then how can we say what was the actual behavior before we were selling this flexibility? So it's like having some reference day as flexibility might be in the future less and less. You will not have it as the system is becoming more dynamic. And then also another issue can be the consensus on a baseline. Like a DSO maybe wants to use average of the last few days load as a baseline. Maybe a flexibility service provider wants to use machine learning. There are different methods to calculate baseline. But what if when these different methods might give different results, different baselines, then how can we, you might get conflict of interest there. So how can we come to a consensus there? That can be a challenge. Yeah, as I said, it's the consequences can be conflict in verification of the service delivery because it is prone to manipulation. Also, if I know what would be the method for calculating baseline, I can manipulate my baseline, either misreport it or start using a bit more the past few days and get a higher baseline so that I can get paid more without doing much more. So these are the challenges that you might have heard about. About forecast errors, yeah, we are talking about local markets, so we are at the low aggregation level. Good forecasts is more challenging, so it can lead to baseline calculation challenges in the baseline. Also, load and production forecasts can be harder because we are at low aggregation level, which might lead to eventually like failures in the delivery of the service. This means maybe the DSO have to cut off some load because the forecasts were bad and the flexibility service provider couldn't provide the service. And also the sellers that are selling the service, they might get to pay penalties because their forecasts weren't good enough. So that's also another challenge. Measurement costs, I have put it here because in some designs I see that there is a requirement for measurements at each flexible asset to be able to verify the delivery. And imagine if we have many flexibility assets in the future in some region, then it would be a lot of cost for implementing it, for these measurements to be implemented. And also will increase the complexity a lot. So how can we make it as simple as possible and as efficient as possible? So with those challenges, with having those challenges in mind, I want to explain the market design into, I have tried to break it down into different modules so we can go through each of them. And then I want to also link the challenges, that which challenge is addressed by which module in our design. So we have the market framework. What are the roles and responsibilities? What is the product we're trading? What are the market horizons? Market clearing is an optimization algorithm deciding which bid should be cleared, which should be rejected. Market settlement is verification of the delivery, and also the payment allocation rule, which is basically the rule that we use, who will get paid how much, who will pay how much. Yes. So this is just the heads up for these are the challenges I was explaining before, and they are when I'm explaining each of these modules, I will show you these components here, which challenge we have tried to address. All right, let's start with the market framework. So first part, roles and responsibility. This might be a bit trivial, but it's good to be presented anyway. DSOs are the buyers of the product in our market. It's mainly aimed for the congestion issues. So they purchase the service for congestion issues, but of course it's linked with the voltage issues as well, indirectly. Flexibility service providers are the sellers of the product. It can be an aggregator or it can be the consumers, or the prosumers that are directly selling to the market, for example, if they are a large industry, or they are contracted through an aggregator. Market operator, it's recommended to be a neutral, independent third party, and its role is to manage the market, receiving the bids, clearing the market, settle the market, etc. Okay, the product design here is the product I was talking about. It's a limit-based product. Sorry. So we call this the product a capacity limit product. It has two different types, capacity floor and the capacity cap. We'll try to explain it using this figure. So here the black line is the sum of all the connection capacities that are sold downstream of a transformer, for example. The blue line here is the loading of the transformer. And here you can see the green line is the transformer rating. And let's say the red line is the threshold, the safety margin that we don't want to cross over to make sure we are not overloading the transformer. So the DSO can see in the year that in a year that in the winter months the transformer can be overloaded. So what the product that he can buy is this limitation of the capacity that has been sold, the connection capacities that have been sold. We call it a capacity limit cap product. Basically, by purchasing this service, the people who are selling the service, they have to keep their net load under this cap. I will show an example a bit later. And it's the same thing for the floor also. When you are requesting this floor product, capacity limit floor, then the net load should be kept above the floor. I hope it makes sense. I will move, and this is to address the measurement costs. The challenge with the measurement costs, because the only thing we need here for verification is the smart meters. We don't need a baseline here either, because it's relative to the sold connection capacity, which is agreed by everyone. It's something on the paper. It's not dynamic. Right. The market horizons, we consider 3 different horizons. A long term for reservation, a short term, which is a day ahead, for example, for activation, and a continuous adjustment market. The long-term reservation market is a call auction. It's for reserving the service and giving the reliability and support to the different agents participating when they are making decision in advance a few years regarding either reinforcing the grid or not, or investing in flexible assets or not. And hopefully it will help incentivizing investments in flexible resources, increasing the liquidity. Short-term activation market, you have reserved some service. Here you will decide, do you want to activate it or not? It's open to the entry of new competitors. So even if someone is cleared here for reservation, they are obliged to bid here in the activation market. But it is open to new competitors as well. So if someone is going to sell the flexibility with lower prices, they can get cleared in this activation market. And it is, like, for example, related to the entry and exit criteria Sophia was explaining. Continuous adjustment market is for addressing the issue with the forecast errors. So in case you see your forecasts are changing, you can adjust it here in the continuous adjustment market. And it's a continuous auction because we want a transaction throughput as fast as possible. So address challenges here, reservation market, we hope that it helps increasing the liquidity by incentivizing investments in flexible assets. And also here, the continuous adjustment markets to help for the adjusting according to the forecast errors. So here is the example I was talking about. It's a very simple example. For example, here you can see the DSO wants to buy 2 years ahead, reserve some capacity limit product, because in winter time in the evening we might get a peak. So he will, this is a hypothetical case, like imagine there will be only 2 end users downstream of this transformer. The product the DSO will request is 35 kilowatts of capacity limitation, and 2 different prosumers will provide, each of them can provide 23 and 12. So by getting cleared with 23, they have to keep their net exchange with the grid, or their net load below this cap. And then when it comes to the day-ahead activation market, here the DSO have bought 35, but the new forecast will show maybe they need to activate only 30 of it. So they will send the activation bid, and then the prosumers these 2 are obliged to bid because they have been reserved. But then there might be another flexibility provider that enters and has a competitive price. The prices are just here, just some arbitrary values. It's for just illustrative purposes. But maybe this one gets cleared instead because it's more competitive. And then eventually we will have the continuous real market afterwards to adjust the forecast errors. Yeah, market clearing. I will not show any formulation here because it might be get unnecessarily confusing or complex. But clearing algorithm is a social welfare maximization. Like from economic theory, social welfare is the area between the supply and demand curve, and we want to maximize it. So that's basically the algorithm you're using. And then market settlement. The verification of the delivery. As I said, here it's with the capacity limit products. The good point is that we don't need extra measurements. If we can just read the net load from the smart meters, then we can verify if the end user have been keeping its net load below the cap or not. So we don't need some extra measurement here. It's easy to verify, relatively easier. Yep, I hope it makes sense. In online webinars, it's hard to see the reaction, but I hope it makes sense. But of course, you can ask questions afterwards. Payment allocation rules. There are some conventional methods that you might have heard about. It's like uniform pricing or pay as bid. Uniform pricing is basically where the demand and supply curves meet each other. They are prone to manipulation in case we have low liquidity, low competition in the market. But there are other also allocation methods that I will not get into deeply in details, but they are from mechanism design in economics and also from cooperative game theory. They are less prone to manipulation or just strategy proof, like Vickery-Clark grooves mechanisms. You might have, there is another name for this, like pivotal mechanisms you might have heard about. They are not based on some discrete rules like we had here where the supply-demand curve meets, but it depends more on this social welfare value that I was explaining, this area. So, for example, Vickery-Clark grooves, you will get paid based on your contribution, marginal contribution to the social welfare. So if I have you in the market, how much social welfare is produced? If I don't have you in the market, then how much social welfare is produced? And this will be the basis for your payment. So basically, if you bid high, you're contributing less to the social welfare because the area between the curves will be less. So you want to say the truth. You want to bid lower. So you don't want to inflate the prices. And the other way around, you don't want to bid very low either because you might not be able to recover your costs. So you will bid your true value. This is a very good property of this mechanism. It has downsides as well, of course. Nothing is perfect. Shapley value is also similarly related to the social welfare. but it is more on like cooperative game theory basis. In simple words, it is the margin, some sort of average of your marginal contribution to the market. But if we have different, if we form different coalitions in the market, like if we have everyone participating, or if we have 2 participating only, or 3 participating, then what would be the average contribution to all these different sub-coalitions of the grant coalition? I have some extra slides if you were interested to hear about it, but I will not get into details at the moment. Eventually, these are a bit less prone to manipulation because they are either strategy proof by design, or they are harder to manipulate because they are more complex, and also they depend on many different factors. So, yep. So basically, we are trying to also use these new methods for payment allocation to not to increase the liquidity directly, but to help lowering the consequences of low market liquidity. So if we can use them to lower the market manipulation potentials here. Yeah, here is the brief summary again. Different modules of the design and which challenges we have tried to address with each module of the design. So final words. Again, I want to say local flexibility markets are not the only solution for obtaining flexibility. So it might be important to check and compare it with other options, like, for example, dynamic tariffs or even grid investments. Maybe at very local levels, the complexity do not worth implementing these markets. Instead, we can just go with reinforcing the grid and then use local flexibility markets at more higher levels, at the city level or at the regional level. These are not recommend, like this is, I'm just trying to raise some questions that there might be better options as well. So it's good to see the whole picture. Also, we want to mention the potential issues with the baseline, that it can get manipulated, and it's can be challenging if we start using them. So working on limit-based products can be a potential solution to that we wanted to share as well. Payment allocation methods can also help addressing the manipulation challenges. So yeah, can be something to test if you are doing research or want to try new ideas. And then future work, we're going to demonstrate this market that I presented briefly here at Chalmers campus, Johanneberg, in next year, 2022. And then we are planning also to quantify the cost and value for capacity limit products. Like what at the moment we talked mainly how the market looks like, but what are the actual costs for providing this flexibility, and what is the actual value of purchasing this flexibility? Can we quantify that somehow? If we can develop some frameworks for that. I think it's also interesting to see what would be the dominant behavior strategy of the different agents when they're participating in the market. There are tools from evolutionary game theory that we can see what would be the dominant strategy and behavior in such markets that we are trying to also check. There can be alternative methods, alternative market designs like capacity auctions that we might have a look into. Like imagine the DSO just auctioning all the available capacity to the end users, and then the end users start trading with each other the capacity. If they have excess, sell it to another end user, or if they have deficit, they buy from another one. And also you can have also long-term capacity, like in the long term when you're auctioning the capacity. You can also see at the cost of adding new capacity and see if the end users are willing to pay for this additional cost or not. So you decide on how much reinforcement you will do. So there might be some other alternative market designs as well. And then eventually, if we would have the time, we want to compare the local flexibility markets to other solutions that I was showing earlier, like tariff design. Which one is there any? Are both of them going to solve the issue? What are the pros and cons with each of them? Can they help each other? Maybe they can coexist. And such questions. I think that was all from my side. I have extra slides if you have questions. And yes, thank you.
Thanks a lot, Nima. If there aren't any questions just popping up directly, can you maybe just tell us a bit about the demonstration again, like on when is it about, when do you expect it to be finalized, and what types of results will you be presenting, and when? Just some practical details.
Yes,
whatever you know about it.
Yeah, maybe David can help me a bit.
Yeah.
If you are here, David. He's more involved in the demonstrations. But basically, maybe I can, maybe he's not in the meeting. So we are trying to, there are different things we're going to test. The first step is to check the technology. Like if we are sending, do we have the IoT platform? So if we send the signals to different like technologies that are flexible that we have on the campus, will it go through? How accurately can we control those technologies? Like these kind of testings. We have to check our congestion forecast algorithm, try to put these different pieces together, and then when we make sure that these all small component or different parts are working, then the market layer will come on top, and then we can see maybe some trading. So yeah, and then the flexibility that we have, flexible resources, it's Akademiska Hus, the real estate owner at the campus. They have large heat pumps, biomass boiler, turbine, battery, and PV. And also we can control the ventilation in some buildings. So these are the flexible assets we have that can be used, that we are planning to use. I don't know if I answered your question, but yeah, overall view. Yeah.
Thanks. So do we have any other questions from the audience? We have something in the chat. Can you see the chat, Nima, or?
If the DSO is the operator of the market platform. I think like DSOs are quite regulated as far as I know in Sweden, so maybe there won't be a big issue. But if the DSOs are the market operator, then they will have access to extra information. And like one of the criteria in market design is like this symmetric information access. So if the DSO sees all the information of the bids submitted to the market, potentially they can use it to gain profit in the market. So that's why it is suggested market operator should be a third party that is not participating in the market.
Yeah, exactly. So it's a way of avoiding abuse of market power.
Yeah. And then regarding transparency, I didn't mention it. We don't include the grid constraints in the market clearing, because if we include it, then maybe this data cannot be shared with everyone, like the grid topology. So it can cause, it can affect the transparency of the market. So we have decided to put it on the side of the DSOs. They have to run this congestion forecast they have, and then submit how much they want to buy flexibility. So it's not, the constraints are not in the market clearing.
Good. I think we can hand over to Thong and the peer-to-peer market design, if he's ready for that. Looks like it. And Thong, you're still muted, just so you haven't.
Can you hear me now?
Yeah, perfect.
Okay, good afternoon, everyone, and thanks for attending this webinar. My name is Thong Vuvan, the CEO and founder of EMAC company. So thanks a lot, Sophia and Nima, for very excellent introduction over the local flexibility market and so principle, power to pool setting. Now I would like to show you the peer-to-peer. With this presentation, I can say that I will focus more on the implementation part. The principle and the market design, I think that we share more or less the same like peer-to-pool, and also the principle that also Sophia mentioned before. Only the technology implementing the market is different. So here we focus on the blockchain and the technology enabling the design. So short outline with short in the rationale, and then the use case for the peer-to-peer market, and also the realization practice. So it's complementary to what you have heard. So not really theory, but also how can we bring such kind of theory to the reality. Of course, you can see, or we see it obvious that the future role of distribution system operator will not the same as today, so it will be different. Also, the cooperation between the transmission and distribution system operator, because more and more flexibility resources are at the distribution level, and less power plant or even large flexibility resources at the TSO level. It also reflects that for now, over 90% of renewable energy are connecting at the low and medium voltage level. All of the electric vehicles are at the DSO level, and even the battery or even medium scale storage system are also at the distribution level. So with this thing, we also understand from the previous presentations that it's very costly to expand the infrastructure, to put more copper, to cope with volatile and also very fluctuation production from renewable energy. So in order to generate the same energy for kilowatt hour or megawatt hour with photovoltaic, we need to have 10 times of grid compared to nuclear, because we only have the sun during the day and not during the night. So with this thing, so I will also mix between the market design and also demonstration activity. So with this thing, we also converting from the theory business of the peer-to-peer design to really build up a platform so that we can do the testing and then validate the concept. So with this thing, we want to demonstrate a DSO consumer flexibility market platform for the local grid congestion and voltage management that include peer-to-peer, IoT and blockchain by technology. So with this thing, the end user or grid user can actively participate into the local energy, not only the consumer anymore, not only the prosumer anymore, but can be a market player. Also, the DSO can even optimize the cost and the prosumer as well, and then they can even create a new revenue stream out of only paying monthly to the energy supplier. And of course, with this thing, we will do the testing and validate the concept for that. Of course, with our vision is that to have a platform that is FlexiGrid, and then design as a DSO marketplace. So different function, like mentioned already before by Nema. So identify where the location, flexibility, showcase availability of the DSR asset, distributed energy resources. And so matching your request and offer, settlement, transaction, so similar to what Nima mentioned. And the marketplace will also be further supported by the blockchain base, so the smart contract, smart billing, micro payment, and also calculation of payout and process also the payment for that. To have some use cases, because so you can see that here why we need the flexibility, and also mentioned in the introduction of NEMA. So for the use cases, we could like to consider is a long-term congestion, which is thing that we can defer or avoid heavy grid investment. Flexibility for operational congestion, we can mention voltage problem overload during the operation, and even for some still bundle DSO, they can use it flexibility for portfolio balancing, or even energy supplier or other players, so that to avoid paying imbalance fee to the TSO. So that is three use cases we could like to consider into our peer-to-peer demonstration or activity. Here is only to have a kind of activation process or buying process. Of course, at previously presentation mentioned that you have to identify or to forecast where you have the flexibility and your need. So that, but before that, we also need to have that kind of pre-qualification, so license to sell or license to buy. So, and then BSO define congestion area or the need area, and publish the auction phase. Flexibility resources, submit your offer, and then now the matching offer again the request. So that is long term, it can be 1 month, 1 week, or even 6 months ago before. If there is no activation, of course, they have to pay some reservation fee. If it's an activation, so they will send a signal, and then flexibility deliver, and then we validate if they deliver or not, and then we pay with the full price at their setting. So that is the process diagram for the market. It's like that. This is only an example, right? Let's say that I can be either consumer or prosumer. So if I think that I can sell 10 kilowatt around 6 a.m. today because I'm leaving, and I have the battery, so it can be available, I can create a fetch offer, then send it to either flexibility broker or aggregator, we can say like that. Or flexibility can even pull it and then sell it at the flexibility market platform for the DSO in this context. So in more detail, we can see that from here the big generator like nuclear or gas turbine going to the transmission, go to distribution, and here are the end user. With this end user, so that is a traditional way. So if we can say that with IoT, we can connect with data, IoT gateway and API to have with kind of layer at the applicable device level. Then we send the data to flexibility aggregation platform, also record with blockchain data, and then with this thing gather the data, the bigger bits to put in the flexibility market, and then DSO, and then go to the control and then provide it to show the distribution grid problem. So that is also another high level, a little bit more detail on the flow of the electricity, but also the flow of the market or signal. Here is also another way to represent the architecture of the blockchain, but I don't go into detail about that. So, of course, in order for us to perform this platform, it's not such simple like that. We still need to connect a lot of API and data to the substation, so the DSO even can fetch the data at the congestion and active zone, and then here also the spot market. So we have to compare also with the wholesale market. And also at the individual, we also have to connect with the smart data and smart meter data, and also IoT for that. So in order to perform all of the activities. So of course, with the testing, we are going to bring this concept to test in Bulgaria, Turkey, also Belgium and Switzerland with different networks area. With that, I also introduce quickly the platform for you to have an idea. Of course, before they're doing trading, they have to registration and also create also a wallet like similar to us. Now it's a virtual wallet, so similar to us. Go to supermarket, we buy something, we also have a wallet with us or bank card with us, so that with that thing we can pay. Then with this thing, so the trader or the DSO or the seller can see the request and offer and current update, the market price, and then also the trading intelligence, portfolio management and support, etc. So with this thing, they can even create the asset or create offer on the platform which they need, and then even do the matching. So here, list of all of my requests, and whenever I click to that, it will show me what is the offer matching with my request. Here is a more location or the size, the price, depending on this one, but it also that I can even select and then buy that. So with this thing, when you see like that, you may have feeling that is an Airbnb for energy. So Airbnb is a small individual household. They can sell flexibility, meaning that the free room for some certain periods to the visitors or tourists. Then here is also similar to that, so that it's similar to this concept. We also can visualize even 5 years ahead the congestion, the level of need to support not only the buyer but also the seller in order to define the portfolio, but also the planning for the trading strategy. So here now is the time for us to do the testing and validation, but before that we also connect API with IoT devices monitoring, also develop the application, decentralized application, also smart contracts, also matching based on the market algorithm that also mentioned in the previous presentation. So thank you very much for your patience and listening to my short presentation.
Thanks a lot, Thon. Could you, I have a short question on the market platform and how aggregators can take part in that. Is it possible, for example, for an aggregator to act on the platform, allowing for a household to just stay out of it and handling all the...
Yeah, they can create a bid on it. For example, from here, they can have the offer And widget thing, it can be individual asset or in a group of asset. So that widget asset they create, the asset is related to location, to the capacity. And then with this thing, they can even create an offer from JIT platform so that either prosumer can do by themselves or the aggregator can create on behalf of them.
Interesting. So do we have any questions for Thong from the audience?
I might have another question,
Yeah.
but it might be general. So I'm not sure if it's on this topic or the previous one. But my question was about the interference with the DSO, the transmission system operator grid. Because if you have a bit for balancing or you have a bit for congestion, it might worsen the scenario for the other system operator. So I was wondering, is this taken care of then by the algorithm, or how do you cover this?
Very, very nice question. Of course, we show it not within JIT project, but we show it in the interface projects. So there are three levels that we can say. So of course, we have the asset and also the capacity at the DSO level. And in this context, it may happen that either DSO and TSO want that asset. So it's very seldom. Or only TSO needs that asset, or only DSO needs that asset, or neither of them needs that asset or that flexibility. So, of course, whatever the blockchain, that's why we have to use the blockchain. So whenever someone like TSO buy, we also send a signal to the DSO that look, TSO have already bought this one flexibility using this hour. So if there is a conflict, something like congestion or something happen to the DSO network, the DSO can even signal back to the TSO that you shouldn't buy this one, you can buy somewhere else. So with these things, we give more priority to the DSO first. Of course, depending on the setting of the market or the regulation, we can adapt accordingly. But for now, that is the assumption that we are doing.
Okay, thank you.
Yeah. But we see that at the end of the day, even we have the flexibility as said like that, but our estimation is that 98% of the time, no buying at all, only 2%, and even TSO and DSO buying at the same time is very rarely. So that is very extreme case. Yeah.
Yeah, I can just briefly say that in the peer-to-pool market, the question that you're raising is very important. I definitely agree, but it wasn't in the scope of our study because it would have get very complex. But it is very important. So how we have thought about it is maybe we can adjust it with when we are opening and closing the markets. If we limit the capacity before the market is cleared on the day-ahead energy market, then this capacity limitation can be shared, coordinated with the TSO going upstream, and then like so that the TSO knows how much flexibility from the distribution networks will be available at different distribution regions. But it's a tricky thing to solve. I can agree.
Yeah, and it's also quite interesting if you look at the new regulation in the clean energy package from the EU. It's when it comes to being a supplier or provider of flexibility as a household consumer, you're actually responsible for your own imbalances that you cause. Well, these are probably quite small, which is not the case as when you're just a normal consumer, sort of. Which is, of course, something that sort of it will probably be sorted out by other actors in the market and not by the actual household. But it's just quite interesting how they decided to go about that. So thanks for a good question. Then we have another one for Thong in the comments sections, which is how do you verify that a domestic home has provided the flexibility that they have submitted?
So we take the signal from the smart meter or IoT. So we verify the let's say the profile that they normally provide, and at the time that they also promise. So with these things, so that we use the detection, the IoT signal, and then the smart contract. So that that is how we detect that they provide or not. If the curve is at running as usual, meaning that no signal, if we see, let's say, a sudden increase or decrease with the direction they promise, then we can validate that they deliver what they promise. But of course, the question is that do we install IoT devices at the very small devices of household? That is very challenging. So now we are testing even at the, let's say, at the charging station. That is a big lot already, so that we can even see that.
And I guess you have the same thinking about this as Nima was, as he was mentioning about what is the proper baseline and such.
Indeed, and it already mentioned briefly, maybe by Nema in the introduction, and I guess if not, we did discuss about that. Yeah.
Yes. Yeah. Sorry, Oliver, you were saying something. I was interrupting you.
Yeah.
Thank you. Sorry, I'm struggling with the controls. And how does that work here for like communications and data protection and things like that? Is there anything special you have to do about that to be able to capture that information?
For the GDPR, we follow the rule of European Commission. For the data transfer, we now send the data via IoT to IoT platform. It's also developed by our partner Simavi. Which is the IoT platform, or either we are temporarily using the Azure for now. So with it, IoT platform, they will aggregate the, how to say, usable data to the trading platform if like. So that is a thing that server layer like that. Why we cannot, why we don't take the data from IoT directly to the trading platform is that it's challenging. Because imagine that now today we still have limited testing, piloting, small number of devices, but in the future we have million devices. We cannot do it with support from IoT platform to store, to collect, and then to transfer the data.
Okay, thanks very much.
Thanks. And then we got another question, which is there added value, or according to you, is there added value to measure behind the smart meter that is sub-metering? For example, individually measuring an electric boiler, should it be encouraged or not?
Yes. And of course, smart meter, of course, that is something between the load and the DSO, but mainly with the energy supplier at a total. And behind the smart meter, we have, let's say, flexible loads, but also inflexible load, that the load, like the lamp or whatever, is not really we consider flexible, or television. It's only the heat pump or the battery or the boiler is it big enough. So of course, the device like IoT devices are cheaper and cheaper, and with the upcoming 5G to come. So the more precise we can signal to the flexibility, the better. Of course, if we all agree that we will use the flexibility, and it had been used for even 40 years in Hungary, like E.ON. They have used it hot water boilers in household, which at time of EU tariff in the years of 70s until now. So it's something, not something new. Whatever we discuss, we think that new, but somehow people have used it in one way or the other. So I think it makes sense, and that is more precise that we can control and then take the signal for that.
Yeah, we got a follow-up comment on that, which is it raises some discussion on the validity on the measurement because of the flexibility service provider is probably the one implementing the submeter, not the DSO.
Correct, yes. The DSO, after the meter, there is nothing to do with the DSO. So of course, depending on the regulation or the setting, but here the third party, here we mentioned about aggregator. They are doing it at the transmission level with a big load, so they have to go and then install the equipment. And then so how they can approve to the DSO, the same will happen at the DSO level. So yeah, so I tend to agree with this comment. Yeah.
I can mention something here regarding the capacity limitation product, that one of the benefits with that is that you do not need this sub-metering. So you just need to read the net load from the smart meter, and whatever is happening behind the meter is the flexibility provider's decision. They want to provide flexibility with whatever technology that they want. They just have to keep their net load below some cap, and we can validate it with reading the net load from the smart meter.
Indeed. Of course, at the beginning, we shouldn't, we should be more, let's say, more precise as much as possible. But the more precise we try to achieve, the more cost or the man hour we have to put in. So at the beginning, of course, it will be some flexibility, flexible from the DSO or even the platform or even device to accept some level of error or some flexibility you can give. So to mobilize liquidity and also the people to start using the service and also to get to understand the market. So at the beginning, we have to accept some level of simplification. I can say simplification, like you mentioned. So we have to accept that, and we should encourage that. Otherwise, we cannot move the market.
Very good. So if that was all the questions we had, I think we can wrap this up. And yeah, I encourage you to take a look at the website, which you can find a link to at the top of the chat. We will, as I mentioned, be publishing a deliverable on there regarding these questions that you can dive into. It's quite a hefty report. It's about 120 pages, I think. So there's a lot of interesting information available. So yeah, thanks a lot for joining us, and have a good day.